As a CPG brand selling in retail, you'll inevitably have to work with distributors along that journey. Within that path comes a lot of opportunities and challenges along with it. One of the biggest things are dealing with distributor deductions and chargebacks. We've gone into before what distributor chargeback deductions are and why they happen, but I really wanted to dive into some of the more advanced techniques of managing these throughout your business because they can be hefty. As I shared before with my business, T Squares, we were getting chargebacks from a distributor with one retailer in particular, and I never took the time to actually break down what that percentage of revenue was. And once I did, it was like almost 30% of our revenue were getting charged back as deductions. And it ended up meaning that we actually were losing money selling to that retailer. And so for this conversation, I've invited on Anush and Zach with Glimpse, who work with brands every day to help them solve and contest their deductions issues. And for this presentation, we'll jump into what some of those advanced techniques are so that you can walk away with some actionable tips. Anush, Zach, welcome.
Awesome. Hey, Jordan. Thanks for having us.
Awesome.
Excited to use this time to run through some advanced deductions techniques. Just some quick introductions. So I'm Manoj. I'm one of the co-founders of Glimpse, and a little about Glimpse in general. We are the first AI-powered service that actually fully manages deductions for consumer brands that are in retail. And so we'll definitely share some more about us towards the end. But with that, I wanted to hand it over to Zach to just give a quick introduction of himself.
Thanks, Anish. And thanks, Jordan, again for having us on. Um, I am Zach. Anush has gracefully determined me as a deductions expert, which I appreciate. I've been in the CPG space since 2018. I've worked for a couple different companies doing kind of the same stuff. I've done, deductions management, trade promotion analytics, data analytics. Really kind of touched all pieces of kind of the trade and deductions side of things. Worked at Health Warrior, eventually getting acquired by PepsiCo. Then worked for Lily Sweets, eventually getting acquired by Hershey, and then worked for Hippie Snacks, and then currently at Nutra right now. And I'm one of the in-house deduction experts working on a couple different accounts, including ones like Emmy and Little Bucks, which we'll kind of get into a little bit later.
Awesome. Thanks, Zach. So with that, we can jump into some of the just starting information about deductions, just to kind of build up to some of those disputing techniques and ways to deal with deductions. So to kick things off, what is a deduction? So in the simplest form, a deduction is when a retailer or distributor pays a brand, they deduct money from each invoice for various costs. And so this can relate to freight, it can relate to vendor software fees, it can relate to the promotions that you're running as a brand. Really, every single cost of doing business with a retailer or distributor is going to be passed through via these deductions that are taken off of each invoice, basically. And so with that, a little more context about these deductions as well. Deductions will essentially scale because they're tied to because they're tied to the cost of doing business with a distributor. They're going to scale as you grow your retail footprint and get your product into more and more retailers and additional distributors as well. So in terms of the scale, brands can receive even up to thousands of deductions every single month as they continue to grow and start going nationwide with big retailers, et cetera. And really the challenge here is that it's a lot to keep track of for most founders and operators who are so busy, in the weeds of sales and marketing and actual product development that then also have to carve out time from their busy schedules to just be reading through very manually sent PDFs. As you can see, here's an example of a deduction, and there's all kinds of different codes that show up on these deductions. So there's an element of one, getting familiar with what these codes even mean, then understanding if they're valid, and actually properly classifying all of those together. So all in all, it's a very tedious and labor intensive process for most founders and operators. I'll hand it off to Zach to share a little bit more about some of the specific types you can expect and a little bit more detail about how to go about dealing with those deductions too.
Yeah, so kind of piggybacking off of what Anu said. So, whether you're just starting in the CPG space, you're in a couple different stores, you're expanding, or you're a seasoned vet in this space, and you're continuing to expand and run promotions and things. Like you're going to consistently see deductions no matter what. But not all stages of where you are as a brand are kind of treated equally per se. So, when you're first starting, you're going to see a lot of intro deductions, we like to call them. So, when you're getting into different retailers like KeHE and Unify, you're going to have these fees they're more one-time fees, but they're going to kind of add up in the beginning. So you're going to have things like, new item setup fees where you have to set up your products and your brand within, KeHE and Unify systems. You're going to have intro allowances where, just within their supplier agreements, they have things that require, certain percent discounts on initial orders, or you're going to have one of the most common ones is like free fill or slotting deductions when it comes to retailers. So you've got to give them free product basically to get onto the shelf. So all those initial fees are really going to add up. And to be honest, at first glance, they're a bit scary because you might reach a point where maybe, upwards of 50% of your deductions to start are, or 50% of your fees are, deductions. So it can get a bit scary seeing that trade rate kind of really climb up there. But, as you kind of get the ball rolling, you kind of settle in and stuff, that trade rate should start to drop and you should start to see more of a consistent pattern with your deductions. But, as you expand and as you start to roll, you'll start to see a bunch of different types of deductions other than those, initial fees and those slotting fees. You'll start to hopefully see promotion deductions, which means that you're, out there running promotions, bringing awareness to your brand and your products, and people are buying your products. So, I guess the one of the key takeaway from here is if you see that number of trade spend really climb up there in the first, couple months, maybe even year of beginning this journey, don't be alarmed. It will come down and it will kind of normalize a bit, but every single deduction obviously matters. They'll add up, and it's just super important to check every single deduction and just make sure that things are valid or invalid.
Zach, thanks for walking through this. I think one of the misalignments that happens for new brands is, industry experts are like, oh, all this is usually in the contract, right? Like if you read through the agreement, you should know what this is. But I don't think first-time founders, especially in new kind of in the CPG role, really understand the financial impact of all these decisions, especially when they add up and take place all at one time or in a very small amount of time, right? You look at each one of them individually and you're like, okay, that's not too bad. But when 4, 5, 6, 7 fees hit on top of each other, that's when it starts to make the impact, right?
Absolutely. Yeah. Yeah. You may be aware of maybe those slotting deductions that are going to come through. You have an idea of kind of how big those are going to be, but to your point, you get hit with that. And then, on the same check, you get hit with the intro allowances, and then you get hit with the new item fees. And it's like, you kind of going back to the, what Anuj was saying, it's like, you expect to get, you sold $50,000 worth of product to KeHE, for example. You expect to see that $50,000 come through in a check, but then you get that check and it's actually $10,000, and you're just like, what is happening? And you kind of go through that check and you see kind of line by line what's being taken, and yeah, it can be a bit overwhelming for sure.
I think it's important to walk through those agreements even when you're getting started so you understand everything that you're selecting, all the options. I forget who it was, either like Unify or KeHE's contract. They basically have a checkbox that says, will you allow them to pitch new business and essentially offer free fills to new retailers? And it's like a checkbox or something basically. And if you say yes, they basically can offer your product for free to any retailer without requesting your permission. And so you could quickly stack up like dozens or hundreds of free fills without you being aware of it in advance.
Yeah, yeah, you're absolutely right. We see that quite frequently with some brands where, we'll ask them if they've authorized the slot, and they'll say no. So we'll kind of go through the disputing process, and Katie will say, this is actually required under section 2.1.3 or whatever of the supplier agreement. So yeah, you're absolutely right.
Wow, wild. Awesome. What's next?
Awesome.
And so now we'll kind of dive, I mentioned just there's many types of deductions that come through these distributors and retailers, and we'll kind of dive a bit into some of the bigger ones. So one of the biggest ones that we see are freight deductions. And what we classify as freight deductions, the simplest kind of high level of freight deductions are going to be like shortages or overages or price discrepancies, anything that's kind of related to like the PO or the invoice. So right here on the right, you'll see a bit of example on the top, and we'll kind of dive into it in the next slide. But like a shortage claim, for instance, is kind of the biggest one. So what that is Keiki orders 10 cases of a certain SKU from you. You as a brand fulfill that order, but Katie says, hey, we only received 9 cases. And so they're saying we're 1 case short, and they're going to bill you back as a deduction for that missing case that they're claiming. So in the next slides, we'll get into kind of the nuances of what shortages are and kind of how to fix them. So like I had mentioned, like, freight deductions, particularly shortages, Glimpse has a lot of success in disputing these and winning these. I think one of the reasons why is that they can be pretty cut and dry for the most part when it comes to validating these, but only with good backup and good documentation around things. So that documentation usually what is required. We like to look at 3 things. So the BOL being the first one. So that's your bill of lading, which is signed by the carrier. And ideally, what this will show is kind of an itemized list of what is included in that order that was shipped. And ideally, what you can do is you can tie that back to what Kehi ordered on the PO. So if Kehi's like, they order 10 cases of A, 10 cases of B, 10 cases of C, ideally that BOL would show, hey, we're shipping 10 cases of A, 10 cases of B, 10 cases of C, and you can match those 2 things together. And so if Kehi or Unify is claiming that, 1 case was not shipped to product A, you can very clearly show them on the BOL and then even the pack slip that's mentioned there as well. Like, hey, we actually sent all 10 cases of this item. This shortage is invalid. And then we would go through the dispute process through the right channels, whether it's Kehi or Unify.
Is there a good process that you found for brands like keeping all that documentation and BOLs, like saving into like a Google Drive, or is there like a good software to keep all that in so you can track them and associate them with like specific invoices?
Yeah, I think one of the best ways we found, just like you mentioned, whether it's a Google Drive or it's a Dropbox of some nature, is dropping those in there. And you know, it might be a small thing, but like the labeling of those things is also super important. So whether it's like a parent folder that's like, hey, this is for PO, 1, and it's got all documentation related to PO 1, whether it's the PO, the invoice, the BOL, the pack slip, the POD, like all that stuff, where you can obviously just name each one of those as like POD, for PO 1 or something like that. So usually a Dropbox or a Google Drive is good. We've also, just used like softwares, like we've gotten access to softwares directly where it's like an SPS Commerce or something like that, where brands have allowed us to kind of, save them time of pulling all that detail down and saving it, just giving us access directly to those systems. And, us ourselves, the in-house deductions experts, can just go look and search for that documentation.
Awesome.
And so one of the next biggest types of deductions are your promo deductions. So, as you expand, as you grow as a brand, ideally you're running promotions, right? Promotions are the biggest way to get your brand recognized, to get people to try your product. Trial is key in this industry to get people to buy it. Hopefully they try it, like it, and then they become a repeat customer, and that's kind of how you grow sales. So with promotions, there's a couple different ways in which promotion deductions can come through. I'll kind of go a little bit out of order here just to make kind of nail on the point here, but like scans, that second bullet down, is kind of the easiest and probably what most people think of when it comes to promotions. So scans discounts are taken off at the point of sale. So the best way to think about this is that every single time a product is scanned through the register at a retailer, so Sprouts, for example, if your product is scanned through the register at Sprouts, whatever discount is agreed upon per item, you're gonna get billed back for each unit that gets scanned. So during the time period of month, if you scan, 10,000 units and you're giving them $1 discount, you'll get billed back for $10,000. In this situation, the brand will win. So for each one of these, I kind of have like a winner of which is best. So in this situation, the brand wins. So, and why I say that is like you're kind of cutting out all like middlemen in this situation. So you don't have to deal with fees from the distributor, KQ Unify. You don't have to deal with OIs from KQ Unify. You're just getting straight up, very clear scan data in this instance. The other big one that you'll see a lot are your MCBs, or your manufacturer chargebacks. So what this is when a retailer, again, I'm going to use Sprouts, if they buy, brand A's product from a distributor like KQ Unify, usually they'll buy it from them at a discounted rate. So KQ particularly will have these like promotion windows in which KQ calls them published promotion windows. So like say during the month of January, they will publish your brand in their, I call it like a catalog. And basically anybody that pulls through KQ is allowed to buy that product for that discount, usually a 15% discount. So they can go on there, whether it's Sprouts or it's a small mom and pop store in, your local town, like they have the ability to buy that product for that discount. And ideally what happens is that retailer that buys it will then pass along that discount to the customer. So this is a very important piece for brands to kind of be aware of, where if there's a published deal with KQ during January, you want to ensure that the retailers that you're working with will run a promotion at the store level during January as well. So, they get that 15% discount from KQ, and then ideally that retailer passes along to the customer. So there's no kind of, inefficient dollars spent in that situation. But with MCBs, the winner in this aspect is going to be the retailer. So the Sprouts, for example. And why I say that is that, there can be instances where Sprouts will buy, 50,000 cases of the product for that 50% discount. And then ideally they're passing that along during the month of January, for example. But, if they don't sell $50,000 worth in January, they can still go and sell that product they bought at a discount during the subsequent months, which, they are basically winning in that instance because they're selling it at that non-discounted price. Unfortunately, like MCBs are kind of required when you're working with distributors. So it's just key to kind of keep an eye on the like buying processes of these retailers and kind of tracking that to make sure they're not like overbuying in these instances. The next ones are
And then
Elias.
in those situations, can you tell them like, no, don't, we recommend you don't buy this much?
You can, yeah. So if there's a, if there's an instance like I kind of mentioned, right, where they're buying 50,000 cases and you've got the historical data to suggest that they're never going to buy 50,000, they're never going to sell 50,000 cases worth in that month. Yeah, you can cancel POs in that situation. Or you can keep an eye on KP and Unify have like shipment reports and things like that. And obviously there's a bunch of different um, data nowadays, spends data, things like that, where you can kind of verify what's been sold, what's been shipped, all that. You can kind of track the inventory levels, and if they're at an excess of inventory for the month of January and they try to buy big again in February or March, you can kind of cancel that PO and just be like, hey, like, we can see you have enough inventory to cover, like order again in 30 days, 60 days, or whatever.
Makes sense.
The next kind of promo deduction is called an OI or off invoice. It is what it sounds like. So it's a discount that's taken directly off of the invoice with the distributor. So similar to MCB, they occur during like promotion windows. So maybe during a month, Unify or KE is offering a 50%, 50% OI. In this instance, again, very similar to MCB. The distributor kind of wins in this situation, and they can do something very similar where they kind of forward buy. So they'll buy a ton during the OI window at that discount, and then they would sell it again later at a non-discounted price. In this situation, there's no like passing the discount along to retailers or customers. The way that I kind of look at it, OIs are they're kind of just like a cost of doing business sometimes with these distributors. Like if you want to be big and Unify or KE and you want to expand and grow, sometimes you just have to do OIs and a couple times a year. Hopefully you can negotiate that down as you show success, but sometimes they're just a cost of doing business. And then the last promo deduction is called merchandising. So usually how it's calculated, it's a fee that's usually calculated off of like cost of goods sold or something like that, just like a small percentage of that. But what it pays for is like, it helps brands have like nice shelf tags. It helps with like restocking shelves. It helps with if you're running displays, it helps set up displays or ensuring like promotion tags are on shelf, things like that. So um, it's an important one, but it's usually, again, it's kind of like a cost of doing business with a retailer. If you're in, Sprouts, for example, Sprouts has a merchandising fee that they charge. If you're in Sprouts, you'll get hit with this merchandising deduction. And again, it's just to ensure that everything is kind of looks good and you're in stock on shelves and things like that.
Makes sense.
So all of that I just mentioned, you're probably thinking, how in the world do I limit this stuff? How can I fight this? Like, what do I even do with all this stuff? I mentioned, I touched on it a little bit earlier, but I think one of the biggest things with all this is just being very organized and detailed and having very detailed backup and documentation around this stuff. So, you know, like the promotional calendar piece, for example, like especially as you're expanding and you're growing, like you're going to run a lot of promotions, and ideally you're keeping, it can get hectic, right? It can be, if you're running 20 promotions during a month with different retailers, like it might be difficult to keep up with what you agreed to. What was the scan rate for that SKU that I'm running? What dates was that again? Was there an ad fee? Like it can kind of get a little bit, confusing, but what we recommend is keeping like a very detailed promotional calendar that kind of houses all that information. So some of the key things that you really want to like have in your promotional calendar, obviously the retailer, I'm running this promotion at Sprouts product. This is very important, especially for brands that have multiple like product groups or different like size products. Like maybe you're running a promotion on your 8-ounce product, but not your 11-ounce product. So it's important to kind of differentiate that. And then one of the biggest ones is your scan rate or your MCB rate. What did you agree to? Did you agree to $1 per unit scan? Or is it a 15% discount, whatever that discount may be? And then your date ranges, be as specific as possible with your date ranges. Maybe you say it's a January promotion, but maybe it's actually only from 110 to 130. So you want to keep an eye on that and make sure that they're not taking deductions before 110. And then a lot of promotions come with like fixed fees, whether it's an advertising fee or an additional display fee, or a lot of retailers have just like a TPR fee, which is like an additional fixed fee that they'll charge you to set up the promotion and things like that. So just having all that information very like detailed out in a promotional calendar is super helpful. And to kind of take it the next step, a lot of retailers will actually they'll actually have like signed contracts for you. So this will happen a lot too, like if you're working with brokers, like the broker may get a signed contract with Sprouts saying like very detailed, basically all the stuff that's mentioned in that promo calendar. It'll just be a contract from Sprouts with a signature that says, hey, Sprouts agreed to this, brand agreed to this, it's signed. And then, as deductions come through, you can reference that detail on there. And if there's any discrepancies within that, you can dispute and just point right to that signed contract. So again, like just documentation is key in this. I know it can seem hectic at first, like you're doing a million other things and documentation is your last kind of priority in this situation, but it'll save you a lot of time in the future if you just set up a process to track all this stuff, especially when it comes to promotions.
Yeah, that makes sense. And I think a lot of founders are like doing this via email and they have like a million emails in their inbox. They're not organizing in one location. And so like you're saying, like proactively for each retailer, each distributor, having a filing system or documentation system that's tracking what you agreed upon, the dates, the method, and then probably even starting to track like the results, like how much was actually spent kind of each month. So you can start understanding the true impact of all these things, and you're able to make sure that everything's valid.
Absolutely. Another pretty common type of deduction that we see, and one that we've had success here at Glimpse disputing, is an early pay discount. And what that is, so, KE and Unify both have terms when it comes to paying. So I believe Unify's generic terms is 2%, 10, net 30. So what that means is that if Unify pays the brand within the 10-day window, they're allowed to take a 2% discount on that. And a lot of times, sometimes what you see occur is that, if the invoice was placed and fulfilled on, call it 1/1, and so that 10-day window puts you at, 1/11, they might be paying that invoice on like 1/15, which is outside that 10-day window, and therefore should be an invalid early pay or terms dispute. And so, it's very important to kind of keep track of that. And that's actually, it can be difficult to track as well, right? Just you're having tons of invoices, hopefully, that KE and Unify are placing, and keeping track of when it's paid. You're probably just happy to actually be paid by them sometimes. So checking that stuff is maybe back of mind, and especially when a lot of times it might just be like $70 or $100. Like, it's very small, but obviously it adds up, especially as you grow and have more invoices. But Anuj can speak to this too, but Glimpse has like a very easy, nice setup in way of checking these early pay discounts to see if anything's invalid. And it's one of those more kind of low-hanging fruits that a lot of people and brands just don't think of. But it's very cut and dry on kind of how, if you can get this money back. So definitely something to keep an eye on.
Awesome. Thank you for that, Zach. So wanted to jump in here now just to kind of talk about, we went through what are the different types of deductions, what are the best ways to manage and dispute them, but to tie it all together, what's even the point of keeping such close track of these deductions, and why is it so important? So starting off with the most numerically driven and piece of evidence that, as to why it's important, is that trade spend can end up being your second or third biggest expense behind salary and cost of goods, as a CPG brand. And so we're talking about a huge chunk of money that's getting affected in this. And accordingly, you can really influence, your destiny by managing trade spend and deductions in general correctly. Just using some of the numbers that we've seen firsthand here at Glimpse, with KE and Unify, we've seen 5 to 10% of deductions be invalid. So when you're looking at the biggest, or one of the biggest expenses, for your business, if you can cut that down by 5 to 10%, that can be a pretty meaningful amount of money. And then, same thing, if you're looking at it in terms of your overall revenue, if your trade spend is something like, 25%, that means 2.5% of your revenue can be going to invalid deductions if it's not being taken care of, being looked at closely. And so it's definitely something that you want to make sure to be keeping track of. The majority of deductions, like Zach said, are going to be valid. They're, things like promotions that you did authorize and that you want to run because, it helps your brand grow. Or it might be, certain fees that are related to freight that, the distributors, are helping out with certain, pieces of the process. So, that's like the fair cost that's agreed upon at the beginning of the partnership. But on the other hand, there are this 5 to 10% of deductions that do end up being invalid, result of human error or otherwise, and ultimately very crucial to stay on top of it. One, just because it is a big chunk of money for any brand. But two, it also really helps with understanding your margins, being able to forecast out your revenue projections, your margin projections, and as you may have seen or may run into in the future, this can be very crucial when it comes to fundraising. It can be very crucial when it comes to any type of money that you want to acquire, whether that be from between factoring to loans to any other type of financial vehicle. All of these numbers are very crucial to both keep in check, but also just to understand when it comes to talking to external stakeholders like investors, creditors, etc. With that, I know I mentioned and hinted about it a little bit at the beginning, but Zach and I are both from the team here at Glimpse, and a little bit about what prompted us to start this business and what we do is just seeing that huge percentage of deductions that actually are invalid. So a little bit about what we do for brands is we automatically pull in and categorize KE and Unify, and just launched Target recently, deductions. And our goal is to proactively identify and fight invalid deductions on your behalf and win money back. So, as we mentioned, it's a very tedious, laborious process to one, go through everything and even understand what it's for, but then to be able to parse through which ones are valid, which ones are invalid. If they're invalid, pull together the actual documentation that proves that they're invalid and send it back is a tedious process. And coming from having worked in the brand world for a few years as founders ourselves, we wanted to really just find ways to help open up bandwidth for CPG founders. So being software founders, it's a similar game when it comes to you want to improve your margin, you want to really optimize what your time is spent on as a founder. But it's 10 times harder for CPG when it comes to all the different things that a CPG founder or operator is juggling. And so the goal with Glimpse is that it's completely done for you. You get a client success manager along with a dedicated deductions expert like Zach, who's helping out with any questions and concerns that you might have about your deductions. And we also have we have partnership structures that are friendly in terms of opting out if you're not seeing the value, paying monthly, and ultimately having no risk in trying it out. And so we would love to chat with you if that's something that's of interest. A little bit about some of the brands that we've worked with. We can share all of this over afterwards as well. But we've worked with brands like Lil Bucks, who have seen awesome success, seeing up to an 8 to 10x ROI and 10 hours saved per week. And a cool story with Lil Bucks is we were there right as they were launching nationwide with Whole Foods, along with a variety of other retailers. And so having this type of system in place was super beneficial in terms of just keeping tabs on those numbers, but also just making sure that as expenses are going to go up with a new retailer launch like that on promotions and things like that, being able to just make sure that we're mitigating any of those invalid deductions was super crucial. And similar story with IMI. We've been able to have huge wins, just in a few months of partnering with them, with a single freight deduction even coming back for 10K. So again, as you can imagine, being able to reinvest money like that into more productive initiatives is kind of our goal with Glimpse, and ultimately the goal of just managing, deductions and making sure that you're staying on top of them in general. And then I think the last thing that we have from our side is that we are offering a new lower cost tier to support growing CPG brands. So if you're emerging, if you're recently gotten into KeHE and Unify and are starting to see that deductions volume grow, Food Bevy's exclusive launch partner for this new lower cost tier. So it'll cover that KeHE Unified Deductions Management, and then has a couple optional extras as well, like a sales velocity dashboard, integrating with QuickBooks, along with other sources like Target and CVS as well. And then you can email Matt at TryGlimpse if you want to get some more information on that.
Anush and Zach, I wanted to say too that like it's wild looking at those numbers of how much money is won back by deductions. And I think, until probably the industry changes overall, like you need to protect yourself as a brand to make sure that you're not getting affected. Because right, like $19,000, $26,000, like that is huge for a brand to get that money back and back to your bottom line. That can make the difference between being, operating a loss and operating profitably for those accounts. So it makes such a huge impact. So I just want to say that, but I love that that's happening. You guys are going to be at Expo West.
We will be, yeah. So, definitely come say hi. Here's just a quick list of the events that you can find us at. So, it seems like it's gearing up to be a pretty fun expo, and so definitely come say hi at one of these events.
Awesome. I love this. Anush, Zach, thanks so much for walking through all these things. There's a lot of information in here. I think as a brand and watching this video is important, one, to just understand the complexity that are deductions and chargebacks, to create a strategy to plan for and to mitigate and contest these charges. And, in doing that, I've done it manually. It is a pain in the ass to do. And so working with Glimpse, I'm glad you guys are working with us to make this affordable for emerging brands so that it's actually putting direct money back into the pocket of brands. I think a lot of services out there are like speculatory in terms of like, oh, if you invest this amount, then maybe we'll kind of get this back. But you have proven track record and getting actual like cash back for brands, which makes a huge impact. So I'm so glad you guys were able to come on and share this.
Yeah, no, absolutely. Thank you so much for having us. We're always happy to chat, even if it's just general questions that anyone has about deductions, or is maybe too early for a real platform, but just wants to get some clarity on what's going on. We just want to be a resource to the community, so feel free to reach out.
Awesome. Thanks, guys.